Welcome back, friends. As the famous saying goes, don't fight the Fed. There is no sense in fighting the central bankers in terms of the liquidity that they are trying to infuse in their respective countries and into the global economy. From time to time, we have seen the US Federal Reserve try to increase liquidity by way of bond purchases, by trying to keep the interest rates rather low, and right now they are nudging towards the zero level. In fact, there has been a threat that at some point of time it can go even into the sub-zero level. Rather than simply looking at the world in binary terms today, technology and the rest, or Wall Street versus rest of the world, we should consider the lessons that we have learned so far this year, and that can help tell us what's lying ahead. First of all, one should realize that there is no point trying to fight Fed, as I explained. Advocates of momentum trading or simply buying assets that keep appreciating have duly benefited. That strategy has been particularly rewarding when it comes to companies with strong growth prospects and solid balance sheets and long-dated bonds. Such an asset mix is not bullish, as it reflects a gloomy scenario of the world economy and not much inflationary pressure. In contrast, the COVID market has, however, not been very kind to investors who have shunned bonds with long maturities or who have been drawn to some of the cheap valuations that are prevailing across global financial markets in areas such as financials, leisure, transport, energy, and industrials. You would be surprised to know, but the gap between the valuations of tech stocks and financials sits at its widest for almost 20 years today. Investors who are hoping for a recovery in growth and inflation could boost assets which are like leisure, transport, energy, financials, and industrials. So, the latest outlook from the US Federal Reserve has projected rock bottom interest rates until at least the end of 2023. It is also worth noting that the US Central Bank does not expect core inflation to rise to 2% and unemployment to fall to 4% until that time. That raises the bar considerably for any return of higher interest rates. Okay? But one bright spot is that the consumers and the companies continue to save cash as a buffer and as a precautionary measure, money that at some point will come to be spent. Residential home markets are booming in the United States as a boost from the pandemic, which has accentuated a desire among many home owners for greater space. You must realize that US has not seen such a robust housing market for 15 years now. All this brings us to 2000 level and nearabouts, right? Important consideration is the potency of the central banks to keep infusing liquidity and keep propping up the economy will wane at some point of time. Given that the interest rates are bumping up against the zero level bound, there is limited scope for further stimulus if the economy falters again. Okay, you can go negative, but that's another story. It may be up to the fiscal policy, therefore, rather than the monetary policy to nurture expectations of more reflationary future. One must realize that US bond market expectations for inflation over the coming 3 decades are sitting around 1.75%. Even a modest shift beyond 2% will completely upset the apple cart. This could really reverberate across financial markets, and this could rattle holders of richly valued tech stocks and long-dated bonds. A market clamor of inflation is back would intensify and would prompt a sharp response from plenty of investors across the world. Already we have seen some amount of trepidation this week. We have got supply side shocks, which many of the world economies under lockdown conditions has exacerbated the supply shocks, and this could lead to an increase in certain commodity prices, which itself can lead to a lot of inflation. The moment the inflation figure starts crossing 2%, there will be a sudden shift from the tech stocks to the financials. As I just explained before I started my video, the gap between the tech valuations and financials currently is at its highest in over 20 years. This is showing that there is a major shift in asset classes which can take place in the near term, medium term, and you need to be very cautious. Calling a turn is always difficult, but I believe that we are nearing that moment in history where a major churn in the asset classes will be taking place very soon. We have seen a trailer of the movie that is yet to be shown in its entirety this last week. I believe that some of that trailer we have seen in this week, but the week that is coming ahead will show to the world a bigger view of what's to unfold from here onwards. Wall Street is getting ready to get rattled, and I believe this week we will see a sharp knock in the Dow, S&P 500 and NASDAQ, and you need to be prepared for it. I see a good correction on Wall Street and also in major global stock indices this forthcoming week, beginning September 21, 2020. Happy investing. Take care. Bye-bye.